Now, when you're running a business or you're actually working in a business and you're trying to move forward in your career, another part of the financial statements you want to make sure you understand is the balance sheet. Now, the balance sheet is a bit different from the other financial statements because the balance sheet is about value. It's about actually explaining, hey, you know what? How much are the assets, the liabilities worth? And then when you subtract those two, it gets you down to your owner's equity. So, let's dive into the balance sheet and let's break it down so you'll understand what a balance sheet is trying to tell you. Because just like all other financial statements, there is a story being told, and you need to understand that story so you know how to make smart decisions in other areas of your business. So let's take a look and jump into the balance sheet. As I said, the balance sheet, it's all about understanding the value. And to break that down, that balance sheet is broken into three distinct parts: your assets, your liabilities, and your owner's equity. And if you take your assets minus your liabilities, it's going to equal your owner's equity, which is the part that belongs to the owners. So let's dive into the first one. Your assets. Assets are going to be, the things that you own that have a value that other people are willing to pay you for. Now, there is a big difference in the reason why I say that other people are willing to pay you for, because, you may hear the term assets and, let's say when you're doing your insurance, policy, you may be able to include your clothes or that personal stereo in your house as an asset for your insurance policy. But when it comes down to your financial statements, the only thing that really are assets are the things that someone else would actually pay you for. Because in your business, you may own a stereo in your office, or you may own a computer desk, or you may have things that are on your desk. But the question that you have to ask yourself when you're trying to figure out what is the value of that, you have to ask yourself, what if I sold this? What would someone else be willing to pay me for this? And that is how you start to determine, hey, you know what? This has a asset value from a financial perspective. And that becomes obvious when you look at things like, your accounts receivable. And what that simply is where you sold a product to a customer and the customer hasn't paid you yet. So you have what you call a receivable, meaning that you have a legal right to where that customer is going to pay you at some specified period of time, whether it be net 30, net 60, whenever. But you know that because you gave that customer the product, that customer legally owes you X amount of money. And that's what they call an accounts receivable. Now, the reason why value comes into play is because, yes, you sold that customer a product, but what happens if that customer goes bankrupt and that customer can't actually pay you? What that means is your receivable isn't worth as much as it was when you sold it. Because if that person can't pay you, then that means your receivable probably isn't worth that much. And that's why the value comes into play. Similar thing with inventory. Let's say if you're selling products and you have a bunch of material, you have a bunch of products sitting on your shelf. And let's say, you're selling televisions and, you have all of the models that came out 10 years ago and you still have them sitting on your shelf. Well, if people are no longer buying the televisions from 10 years ago, then I would probably say, those TVs that you have sitting on your shelf might not be worth as much as they were when you bought them. So the value of those televisions will kind of be determined based on what is someone else willing to pay you for it. And then fixed assets are going to be things like, the machinery, the equipment, the vehicles, the building, the things that you buy to help you actually either create the product or to help you run the business. They're not things that you sell on a regular basis. For example, like, if you have a building where that's where you conduct business, if you're not a realtor or you're not a builder, you're not in the business of selling buildings. you are in the business of selling your product. You just need the building to conduct your business. So that building would be considered a fixed asset. And then the next area is going to be your liabilities. Now, liabilities are where you owe someone else money. When we're talking about accounts payable, when you think about that, think of all of the inventory that you bought that you want to sell these products. So you had to buy the products, and then your aim is to sell the products to a customer and collect the cash. And then you want to pay your vendors, the person you bought the product from. So let's say, go back to a television example. Say you're in the business of selling televisions. Well, if you're the one that makes the televisions, you had to buy the material, you had to buy the wiring, you had to buy all of the plastics, the screens, whatever is involved for you to make that television, you had to buy that material from someone. And when you bought it, you told them, hey, give me 60 days to put this together, to sell it to a customer. And when they pay me, I'll be able to come back and pay you. So what they have is a legal right or a legal obligation where you owe them money. That's what you would call an accounts payable. Means they gave you something and you owe them money at some point. Now, the ideal thing is the hope you can actually sell it to your customers, get the cash, and then pay them before you have to pay your vendors. And then when it comes down to accrued expenses, these are expenses that are, where you've been given something and you owe someone money, but it's not related to the actual product. I mean, think about things like your utilities, and think about, the property taxes for the building, things like that, where you owe money for, you say, non-product related cost items. Things that you owe the utility company money to pay your utility bill, but you just haven't paid it yet. You haven't handed them the cash yet. So it sits on your liabilities to say that, hey, although you haven't paid them yet, you still owe them the money. And until you pay them, then it's going to sit on your balance sheet as an accrued expense. And then we get into short-term debt and lines of credits. These are where you take out, usually smaller loans for a shorter period of time. Like, you're going to pay these back in less than a year, or these are the loans or the portion of the loan that you need to pay your creditor back in less than 12 months. And then you look at your long-term liabilities. Those are going to be typically your larger things that you owe over a longer period of time. Let's say, if you took out a loan, now a portion of the loan based on your payments is going to be due within the next 12 months. But then the rest of it, you may pay over 10 years. You may pay over 15 years. I mean, one of the easiest ways to think about this is if you own a home, think about a mortgage. Now, the bank gave you a loan to buy your home. They don't expect you to pay off your home in the next 12 months. What they expect is they expect a certain number of payments to happen in the next 12 months. That would be the short term. But the rest of the balance, they expect you to pay over the next 30 years. That portion would be sitting in your long-term liabilities. And then when you add all that up, you'll have a total liability amount. And then, as we talked about in the first section, you have a total asset amount. And when you take your assets minus your liabilities, you're going to end up with owner's equity. Now, owner's equity is where it really is what the owners own, like how much is left for the people who actually own the company. Now, if it's a publicly traded company, it's going to be your stockholders. So you may see the name stockholder or owner's equity. They change them out depending on the type of business you have. Now, with that gets broken down into two sections. If you think about it, it's the money that they invested up front. Say, you wanted to become an investor in a business and you put up $10,000 in that business. Well, in the owner's equity section, you're going to have $10,000. Now, the second part is if at some point throughout the time of you owning that business, the business decided to pay you back, or the business decided to give you some of your money back, then that would be a capital withdrawal. That's where the owners have taken money out of the business. And if you've taken money out of the business as a capital withdrawal, then that will reduce your owner's equity or reduce the stockholders' equity number. And then there's the additional paid in capital. Now, typically you see this with, a lot of larger companies where additional paid in capital is where, let's say the company is worth, $10,000, but you decided to put in $12,000. 10,000 will go into owner's equity, and the additional or incremental $2,000 will sit in additional paid in capital, because it's capital that you put in the business that is above the actual value of the business. And then you go into retained earnings. Now, retained earnings are going to be, this is where you start to see a connection between the balance sheet and the income statement. Now, as we talked about in an income statement training, and if you haven't seen the income statement training, you should definitely pick that training up, where we go through all of what happens in the income statement and we get down to something called net income. And we also talk about dividends. So your retained earnings are going to be the amount of money or the amount of profit that you made in your business after you have paid dividends. And whatever that number is left, that's what goes into your retained earnings. And when that sits in your retained earnings, that sums up what you have in the equity column. Now, you will be able to calculate this separately, but whatever you calculate by adding these three things up, your stockholders' equity, your additional paid in capital, your retained earnings, all three of those things should be equal to your assets minus your liabilities. So let's look at an actual example. Let's look at Facebook's balance sheet. Now, if you look at Facebook's balance sheet, at the very top, you're going to see their assets. And the way they break it down is, you have your current assets, which are those things that you expect to be able to turn into cash, or they are cash or can be turned into cash in less than 12 months. So you have your cash, your marketable securities, your accounts receivable. That's where they have sold things or they have offered a service and there are other people who owe them money. Then you have your property, plant, and equipment, which is also another name for fixed assets. And then you have all of your other things like your operating leases, your intangibles, goodwill, other assets. All those will kind of fall under your fixed asset group. And then you jump down to your liabilities, where you see you have your accounts payable, your partner payables. Partner payables probably very similar to accounts payables. And then you can see all of the different types of liabilities. And then in the bottom section, you see the equity. And if you add it up and you look at it, you see that your total assets are $133 billion minus $32 billion of liabilities, gets you back down to your total stockholders' equity is $101 billion, which tells you that your assets minus your liabilities equals your owner's equity. Or some other ways that people like to look at it is if you add up your liabilities plus your equity, so the 32 billion plus the 101 billion, it's going to equal 133 billion, which happens to be the exact number of your assets. So there you have it, a quick understanding so you can understand your balance sheet and the different components within your balance sheet, because the balance sheet is all about value and it is comparing your assets minus your liabilities equals the value that is left over for the owners in the owner's equity, or sometimes called your stockholders' equity.